If you take a step back and you think about Citrix as an organization, for the last 30 years we've been focused on connecting people and information on demand. And we've evolved the organization over this period of time just based on the fundamental demands of our customers as well as the evolution of technology. Over the last 2 or 3 years, we laid out a strategy that basically said we want to help our customers adopt cloud services in a hybrid fashion in a way that meets the pace that they're on. A lot of our CEOs and CIOs we talk to are focused on how do we improve productivity of our employee base, how do we adopt cloud and mobility at the same time, all within a security envelope. And so we've been executing on this strategy that we laid out in the middle of last year, and fortunately we're well ahead of our original trajectory.
How much higher margin is the cloud business relative to what might be described as the classic legacy business?
Well, the overall margins of the company are about 30% last quarter, up from 26% a year ago. If you look back over the last several years, we've taken margins from the low 20s up into the low 30s, and we project that we're going to be able to stay in the low 30s over the course of the next several years. Overall, the margins, just the way our margin profile is set up, our services are not highly compute or storage intensive, and therefore we can maintain margins that are much more typical for an enterprise software company.
There's a headline out right now. Analyst community hates or loves Citrix systems. Those who have been on the wrong side of this thus far this year have been burned. But when you think about effectively the next year and how much you've outperformed, do you think it's? I mean, can you maintain the level of growth?
Well, a few quarters into a multi-year.
David, let me actually ask in a different way, because actually it reflects the Facebook issue today, which is, and I'm not saying that you've sandbagged expectations before, but how much have you purposely set a bar that you can always jump over?
Well, I think the issue for us is when you're going through a multi-year transition, and the most important thing is laying out a framework so both customers and investors understand where you're going, why you're targeting certain metrics, and then you can execute within that envelope over a protracted period of time. And the mix of subscription versus typical perpetual license is going to move around from quarter to quarter. Last quarter it was 42% of our new sales were coming from subscriptions. A year ago it was 30%. And as that mix changes, the reported financials are going to change along with that. So our strategy has been to lay out that overall framework so that as we execute, the quarter-to-quarter gyrations aren't going to be a surprise to our investors. Okay. So when we look forward, we think we're in the early innings of a multi-quarter transition, and we've laid out targets all the way to 2022 just against that same strategy.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.